let's go back to January 2026. The silver market, well, it wasn't just hot. It was an absolute supernova. Prices were shattering records left and right, investors were totally euphoric, and you had analysts on TV calling it gold on steroids. But then, in just a single day, that whole party came to a screeching, catastrophic halt. On January 30th, the silver market didn't just dip, it completely nosedived. We're talking a 30% plummet in one day, a collapse of truly historic proportions that just wiped out billions in value and really left a trail of financial devastation in its wake. And to put that into perspective for you, you've got to go back over 4 decades, all the way to 1980, to find a day that was this bad for silver. So, this wasn't just a market correction. This was a watershed moment, a panic that sent shockwaves through the entire financial world.
So what on earth happened? How did a metal that seemed so completely unstoppable suddenly become toxic overnight? Well, that is the story we are going to unpack right now.
Okay, so first things first, let's just try and grasp the sheer scale of the damage here. Because on that one day, the numbers, well, they were simply staggering. The damage was just across the board. Spot silver down 28%. Silver futures, the bets on its future price, they got hit even harder, down over 31%. And the panic, it even spilled over into gold, which is supposed to be the traditional safe haven asset. It plunged 9%. This was a brutal, brutal liquidation of precious metals. Every bubble needs a pin to pop it. And for the great silver bubble of 2026, that pin came directly from Washington, D.C. It was just a single, really powerful announcement. So on the morning of January 30th, President Donald Trump announced his nominee to be the next chair of the Federal Reserve, a guy named Kevin Warsh, a former Fed governor. And almost instantly, the markets reacted with absolute, total panic. I mean, this timeline really shows an almost perfect cause and effect. Think about it. On January 29th, silver is at its absolute peak. We're talking over $121 an ounce. The very next morning, the Warsh nomination is announced, and by that afternoon, the market is in a complete freefall. The connection is undeniable. So the big question is, why did this one name cause such a violent reaction? Well, it all comes down to this one term, hawkish monetary policy. See, Warsh was seen by the market as a hawk. That means he would likely favor higher interest rates to fight off inflation. Now, higher interest rates make the US dollar stronger. And because precious metals are priced in dollars, a stronger dollar just crushes their appeal. The market didn't wait around to see what would happen. It priced in this entire massive policy shift in a matter of hours. But look, that nomination, it was just the trigger. To really truly understand the crash, we have to rewind and look at the absolute mania that came before it. The market wasn't just optimistic. It was in a state of pure, unadulterated euphoria. The scale of this rally was just breathtaking. In 2025, silver was averaging a very healthy $48 an ounce. But by its peak in late January 2026, it had skyrocketed to over $121. That's a massive, almost vertical run-up. So what could possibly convince everyone that this was sustainable? Well, there were some very powerful fundamental arguments going around. You had a weak US dollar through most of 2025 that made silver look cheap. Industrial demand was exploding from things like AI data centers and green technology, both of which need a ton of silver. There were actual physical supply shortages, and on top of all that, you had retail investors piling in, chasing that momentum in a world filled with uncertainty. It really seemed like a perfect storm for higher and higher prices. The hype was it was completely off the charts. The financial press captured the mood perfectly with phrases just like these. Whenever the market narrative becomes this one-sided, it's often a huge red flag that things have gone way too far. The stage was definitely set for a fall. So, and this is the crucial point, that political news was just the trigger. The reason a small fire turned into a raging inferno was because of all these hidden forces that were just lurking right beneath the surface of the market. And the most important of these forces is leverage. Put simply, this is just investing with borrowed money. And it's like throwing gasoline on a fire. When prices are shooting up, leverage makes your profits feel amazing. But when they go down, it magnifies your losses exponentially. And that is exactly what happened here. Here's exactly how the dominoes fell. First, the Warsh nomination caused that initial price drop. That spooked the smart money investors who had ridden the wave up, so they started selling to take their profits. That selling pressure then triggered what's known as margin calls. That's when the lenders demand that leveraged investors pay back their loans immediately. And to do that, those investors had absolutely no choice but to sell their silver at any price, which led to a tidal wave of forced selling and just outright panic.
And as if that wasn't enough, right in the middle of all the chaos, the CME exchange jacked up the margin requirement. That's the collateral you need to trade silver futures by a massive 36%. This was the final nail in the coffin. It put immense pressure on traders and forced even more selling. It was a vicious, self-reinforcing cycle of doom.
So, in the aftermath of all this carnage, who was left standing and who was carried out on a stretcher? Well, the winners were the traders who bet against the silver bubble, the short sellers. Some of the low-cost mining and royalty companies who had smartly locked in high prices also did really well. The losers? Well, it's the people who always seem to get hurt in these situations, the heavily leveraged retail investors who bought right at the top, but also big industrial users like Tesla and Apple, who were suddenly exposed to these wild price swings for a component they absolutely need. And of course, all the hedge funds that were caught on the wrong side of the trade. You know, this whole event might seem unique, but really, it fits a timeless pattern. The legendary trader Jesse Livermore said it best almost a century ago. The specific stocks or the people involved might change, but the underlying psychology of pure fear and greed that drives these bubbles and busts, that is a constant. Which leaves us with the ultimate question. Was the great silver crash of 2026 a brutal but necessary correction that maybe created a historic buying opportunity for a critical metal? Or was it simply another timeless warning about the dangers of market euphoria, of leverage, and of the madness of crowds? The answer, as always, probably lies somewhere in the middle.